Welcome to the video. Today we will question a common mantra: always max out your Roth IRA. Specifically, we will explore whether it should be your absolute top financial priority. We will lay out a practical hierarchy that elevates free money and safety before aggressive retirement contributions, compare Roth versus traditional IRA choices, and show how consistency and time amplify your results. To begin, let's set expectations and outline the agenda for our discussion. Here is the agenda. First, we will clarify why the Roth IRA is so popular. Next, we will walk through the hierarchy of wealth and why free money and safety nets come before everything else. Then, we will compare Roth and traditional IRAs. After that, we will highlight the power of time and consistent contributions. We will also provide a step-by-step plan. Additionally, we will use diagrams to visualize the roadmap. We will test your understanding with short quizzes. Finally, we will recap with key takeaways and a concise summary. The Roth IRA is widely praised because contributions grow tax-free and qualified withdrawals in retirement are tax-free. For a young earner around an $80,000 salary who is investing in diversified index funds, or a mix, including some growth stocks, the instinct to maximize the Roth IRA is often correct. However, we must ask whether it should be the first priority in a comprehensive financial plan. To answer that, we will organize priorities using a hierarchy that protects against common financial risks while still capturing long-term growth. Let us establish a strict priority order. First, always capture your employer 401k match because it is effectively free money and a guaranteed return. Next, build an emergency fund of 3 to 6 months of essential expenses in a high-yield savings account. This buffer prevents you from tapping tax-advantaged accounts during emergencies. Then, eliminate high-interest debt such as credit cards because the interest rate likely exceeds expected investment returns. After these steps, maximize the Roth IRA to harness tax-free growth. Finally, implement broad, low-cost index funds to build a diversified, low-maintenance portfolio. With this hierarchy in mind, we can test your understanding with a quick quiz. Quiz time. The question is, what should typically come before maximizing a Roth IRA in a sound financial hierarchy? Option A is picking individual stocks for higher upside. Option B is capturing a full 401k employer match and building an emergency fund. Option C is ignoring high-interest debt to avoid missing market gains. Option D is timing the market with short-term trades. You may pause the video now to consider your answer. We will discuss the correct answer in the next section. The correct answer is B. Capturing the employer match and establishing a solid emergency fund come before maximizing a Roth IRA. This order ensures you are not leaving free money on the table and that you have a safety net to prevent disruptive withdrawals during crises. Now that we have affirmed the hierarchy, let us compare Roth and traditional IRAs to understand which may fit better at different stages of your career. Here is a concise comparison. A Roth IRA involves paying taxes now, often while you are in a lower tax bracket early in your career, and receiving tax-free growth and tax-free qualified withdrawals later. A traditional IRA provides an upfront tax deduction, which reduces current taxable income, but withdrawals are taxed as ordinary income in retirement. A common strategy is to use Roth contributions aggressively in the early career years and then gradually shift to traditional contributions as your income and tax bracket increase. Be sure to verify current IRS rules, contribution limits, and phase-outs, as these can change. With the high-level comparison made, let us visualize the differences briefly before we move to a detailed plan. This quick comparison shows that Roth IRA contributions are taxed today, but qualified withdrawals are tax-free, and they can be attractive early in a career when tax rates may be lower. Traditional IRA contributions can be tax-deductible now, which may be attractive if you are in a higher tax bracket and want immediate tax reduction, but withdrawals are taxed later. Additionally, required minimum distributions generally apply to traditional IRAs, while Roth IRAs do not have required minimum distributions for the original owner, subject to current regulations. Next, we will illustrate how time and consistency expand outcomes. This timeline emphasizes compounding across decades. At the beginning, around age 22, the investor starts consistent contributions in broad, low-cost equity index funds. By age 30, after promotions or income growth, contributions may be increased. By age 40, the investor rebalances risk as life circumstances evolve, and ensures the emergency fund remains adequate. At age 50, potential catch-up contribution rules may apply depending on current law, and diversification continues. By age 60, the focus shifts to withdrawal planning and tax-efficient strategies. The overarching message is that consistent contributions over time are the most powerful driver of outcomes. Now let us move to a concrete step-by-step plan. Here is your practical plan. First, capture the full 401k employer match. Second, build an emergency fund covering 3 to 6 months of essential expenses in a high-yield savings account. Third, eliminate high-interest debt such as credit cards. Fourth, if it fits your situation and eligibility, aim to maximize Roth IRA contributions. Fifth, select broad, low-cost index funds, for example total market funds, to maintain diversification and efficiency. Sixth, reassess annually to adjust for income changes, tax situation, and risk tolerance, and to rebalance if needed. Seventh, as your tax bracket increases later in your career, consider transitioning some contributions to a traditional IRA or traditional 401k to benefit from deductions. Next, we will look at what to invest in inside these accounts. Inside your Roth IRA or other accounts, prioritize broad, low-cost index funds. Examples include total U.S. market funds and global or international options. Avoid frequent trading and emphasize diversification and low expense ratios. For younger investors with a long time horizon, an equity-heavy allocation such as 80% U.S. total market and 20% international can be a reasonable starting point, though this is not personalized advice. Over time, as your goals and time horizon evolve, you can add bond exposure or reduce risk accordingly. With the investment building blocks in place, let us do a quick knowledge check. Second quiz. The question is, which scenario most favors Roth IRA contributions over traditional IRA contributions? Option A is an early career earner likely in a lower tax bracket today. Option B is a late career earner seeking a large current year tax deduction. Option C is an investor with no emergency fund and high interest credit card debt. Option D is a trader attempting to time the market for short-term gains. You may pause the video now to think about the answer. We will discuss it in the next section. The correct answer is A. An early career earner is often in a lower tax bracket, making it attractive to pay taxes now and allow investments to grow tax-free for decades. A late career earner seeking deductions may find traditional contributions appealing. Regardless, it remains essential to first secure an emergency fund and address high-interest debt before maximizing retirement accounts. Now, let us reinforce the decision process with a flow diagram. This decision flow lays out a clear path. Start by assessing whether a 401k match is available and contribute to receive the full match. Then verify whether you have 3 to 6 months of expenses saved in an emergency fund. If not, prioritize building it. Next, evaluate for high-interest debt over approximately 8 to 10% APR. If such debt exists, pay it down before investing aggressively. If not, proceed to maximize the Roth IRA. After that, invest in broad, low-cost index funds and reassess each year. To make this even more actionable, let us look at a compact checklist table. This table summarizes the plan. First, capture the 401k match for a risk-free return. Second, build an emergency fund to avoid forced withdrawals during crises. Third, eliminate high-interest debt because paying it down is a guaranteed return. Fourth, maximize Roth IRA contributions to harness tax-free growth. Fifth, select low-cost index funds to maintain diversification with minimal fees. Sixth, reassess annually to adapt to changes in income, tax situation, and objectives. Now, let us distill the most important takeaways. Key takeaways are as follows. First, prioritize free money and your safety net before maximizing a Roth IRA. Second, consider Roth contributions earlier in your career and potentially traditional contributions as your tax bracket increases. Third, recognize that time and consistency generally outperform attempts to pick individual winners. Fourth, contribution limits are use it or lose it, so each year's space is valuable. Fifth, always verify current regulations and tailor decisions to your personal circumstances. With that in mind, let us summarize the entire discussion. In summary, Roth IRAs deliver compelling, long-term tax advantages, but they should not necessarily be your first financial step. The recommended order is to capture your 401k match, build a sufficient emergency fund, eliminate high-interest debt, then maximize the Roth IRA, and finally allocate to broad, low-cost index funds. The choice between Roth and traditional depends on your tax situation now and in the future. Early in a career, Roth is often advantageous. The most important drivers of success are starting early and contributing consistently. Finally, reassess every year, remain diversified, and manage expenses. Before we close, please review an important disclaimer. Disclaimer: this video is for educational purposes only and does not constitute financial, tax, or investment advice. You should verify current regulations and contribution limits, and consult a qualified professional who understands your personal circumstances. Rules can change, and what is appropriate for one individual may not be appropriate for another. With that noted, let us conclude with a call to action. Thank you for watching. If this roadmap was helpful, please like, share, and subscribe. I would love to hear your priority order and the reasoning behind it, so please share your thoughts in the comments.